Good day, everybody. Chris Heerlein here of Reap Financial, coming to you live today, 11 a.m. It's 11:05 as we kick things off. We got a lot of time for your questions surrounding retirement landscape, your investments, your IRAs, 401ks, Social Security, Medicare, and a lot more. We got a great show lined up for you today. We're going to be talking about something that applies to so many of you, whether you're retired or not retired. And what that is you've been working for many years. You've got a lot of different accounts floating around out there. And when you leave an employer, oftentimes you may have a 401k that you've been, socking money into over the years. And so the question is what do you do with that 401k when you leave? So we're going to address that today. And then I want to talk about some year-end tax strategies that you want to be considering as we're walking into the back end of the year here. And you're going, okay, is there any last minute things I can do? There's often some accounts that are really overlooked that I want to make sure that you're aware of today to see how that may potentially fit in your year-end tax plan. So we've got a lot lined up, and we're going to take your calls and questions. Join me right now, 512-836-0590. Isaac's got the phone lines open. We are ready for you today, 512-836-0590. So the question is should you roll over your former 401k into an IRA, or should we just leave those funds there? Does that make sense to leave it or to roll it? And let's just start with the power of IRAs and the value of these IRAs in retirement. As you are putting money in these things through the years, you're doing it obviously to save for your future retirement, but you're also doing it because you like a tax break. So when you max out your IRAs, when you max out your 401ks in these working years, through those higher earning years in your 50s leading into your 60s, you are looking for tax deductions. I get it. So under today's law, when you put the max in there, or really any dollar amount in there, it's going to help you when it comes to year-end tax savings, because every dollar you get into these accounts will not show up on the bottom line of the 1040 come April. Okay, so you can get a nice sizable tax deduction. For you over $50,000, $30,000 can go into that 401k of yours. And for those of you over 50, you can put $7,000 into these IRAs. So the other thing is when you are thinking about your long-term savings, I want you to think about, the value of that account. What I mean by that is if you were to just dive into your IRAs and 401ks with me right now, just dive into your specific account, and you probably have an idea of how much you have in one of those accounts. So think of that value right now. Is it 600,000? Is it 1.8 million? Is it 3.6 million? 200,000? Whatever it is. Okay? So take that number and realize that that number is potentially not worth anywhere near the balance that's currently in there. Why do I say that? It shows up on the statement, but if you've listened to the show long enough, you know where I'm going. You will not be able to net those balances that you are looking at on the screen or on your statements, because every dollar is going to be taxed as income. All right, so if you've got $1 million in there, and you're going to withdraw money from that through retirement, and you're in a 22-24% tax bracket, well, then that tells me right there that that account is probably only worth, that $1 million account net value is only worth maybe $750. Obviously, things will grow. Obviously, that number could change. But the thing about getting a tax deduction in today's economy, with today's tax rates, is yes, you are getting a tax deduction today, but all that is happening is the government is giving you a loan. They're giving you a loan. Many people argue, well, there's more going into the IRA because I don't have to pay tax in the year I put it in. That's true. But the money's on loan, because when you pull it out, you will have to pay tax. And that will be taxed at whatever future tax rates will be, which potentially could be higher than today. And so you got to consider, do you want to get tax breaks today on the $30,000 that you maxed out your 401k? Or do you want tax breaks later on the $3 million that it's potentially worth in retirement? Everybody says, no, the bigger number, right? So consider that, because when you put everything in those, it may not be worth that when it comes down to the net. So the difference then between IRAs and Roth IRAs, traditional 401ks and Roth 401ks. With the traditional accounts, you get that tax deduction today. When you put the money in the Roth portion, you're not going to get a tax deduction. And that's hard to swallow. Right, here I am, year end here with you on KLBJ, and you're waiting for me to get to our segments today where I'm talking about some year-end tax strategy, because our brain, we're wired to get tax deductions today. So if you get in the Roth game, you start putting money there, you're not getting a tax deduction. In fact, if you're not in the Roth game and you're saying, well, I make too much money to put money in the Roth, well, let me clarify a few things. If you make over a certain amount of money as a single or married filer, you can't put money in a Roth IRA, but you can put it in a Roth 401k. There's no income limits when it comes to the Roth 401k. Now you may be saying, well, Chris, I'm retired. I don't have a 401k anymore. Maybe I've got a job where I don't have a 401k option. If that's the case, you can still get in the Roth game. If you have a single dollar in that IRA or 401k, you can convert money. There's no income limits on how much you can convert, or if you can convert it at all. And so that being said, you want to be measured. You don't want to convert too much into in 1 year. You want to do it over many years. But to take it one step further, as I'm mentioning, we're wired to not pay tax. Well, be aware, you convert IRAs, 401ks to your Roth, you're going to pay tax on whatever amount you convert. And so again, there's a mental block there. There's a mental block for families because you're not wanting to increase your tax bill. Well, I had a couple great conversations this week with some families. And these are conversations we have with all of our advisors and families at Reap Financial. And it's this: should I convert today? Should I put money in the Roth today? Well, listen, if you're going to retire next year and you're making $200,000, $300,000, $400,000, and you're 62, if we get you retired next year, does it really make sense to convert this year? Because if your income is going to be substantially lower next year, well, in that case, what are we doing? Obviously, we likely want to wait. If you want to consider doing a conversion while you're working, in many cases, it may be just advisable to convert enough to max out your current tax bracket. That's a possibility as well. But with that said, you want to be measured with this. You need to be tactical with this. You need to work with a CPA. You need to work with a fiduciary advisor to kind of guide you through areas and where you may want to start on this path. I want to take a text question here. You can join me here at 512-836-0590 from Susie. Does your money continue growing in a Roth IRA? Susie, when you convert money to a Roth, it's not an investment. Okay, it's just the only thing that changes when you move your mutual funds, your stocks, whatever you are converting over, is the tax designation changes. So you don't have to sell your stocks to convert to a Roth. You don't have to sell your equities. All that's going to happen is the value that you convert will show up as income in that given year. So your investment can remain the same, or you can purchase another investment. So to that said, depending on the type of investment you have in there, potentially it's going to continue to grow. And so that's a big misconception. People are like, well, I really like my securities, and I've had this mutual fund or these dividend stocks forever, and I don't want to sell them. You don't have to sell, Susie, when you go into that thing. That's the best part about it. Just be mindful of the amount that you're doing. So the first reason, as I wrap up our first segment here today, that you may want to consider rolling your 401ks into IRAs is the benefit of being able to convert to a Roth, or a portion of it to a Roth, in a given year. And many plans particularly if you're no longer employed. You've got an old 401k. In many cases, you may not be able to convert within that 401k. So by moving to an IRA, that may open up some additional options. Chris Heerlein back with you. I am in studio today. It's 11:18 a.m. Please join me right now, as Susie did on our last segment, 512-836-0590. You can call in. We got Isaac standing by for your call, and or text your question at 512-836-0590. I want to encourage our listeners, particularly those that have tuned in with me for nearly a decade, to go to YouTube and subscribe to our channel at REAP Financial, REAP Financial, where I've got an amazing amount of content on there. And I drop new content every single Wednesday so that our listeners can stay on top of the latest. So subscribe to that YouTube channel. Got tons of content on there around everything you need to be aware of walking into and after you have pulled the trigger and retired. So today I'm talking about things around your IRAs. And, one of the big questions we get every year is, should we roll over these old accounts, 401ks, maybe an old IRA floating around there? Should we roll it into an IRA? There's a reason to do this and there's a reason not to do this. But some of the main reasons people consider rolling over old 401ks or a 401k after you retire into a traditional IRA or Roth IRA is just consolidation. It's not hard to think that you may have a lot of mail in your mailbox come into the month when all your statements are coming in from the banks and you've probably got 3 different brokerages and maybe you got 2 401ks out there. So the idea of simplifying and consolidating, particularly going into retirement so you can get a better view of everything, that can make a lot of sense. And then also consider the flexibility within the investments, okay? I'm going to challenge you. If you have a 401k floating around out there, ask yourself, when is the last time that you really took a look at it? When is the last time that you analyzed your fund options available in it? Traditionally, these fund options will change throughout the years. So maybe there's better options, maybe an option that you liked before isn't available anymore. When is the last time you analyzed that old 401k and compared it with all of your other assets? Is that old 401k complementing what's going on in everything else that you're doing? So the idea that you can have more flexibility in an IRA can make it attractive to consider rolling over a former 401k. The reason for that is generally in your 401ks at a current employer or a former is you are limited to the mutual fund options that they've provided. And what I've seen historically is that the larger the company, the more employees that it may have, those type of plans in many cases will offer more fund options. It can offer more affordable fund options. In some cases, smaller companies, they may offer fewer options or more expensive options. Not for every company, I want to be very clear. But the majority of 401ks out there are utilizing mutual funds. And so there's nothing wrong with that, other than you got to ask yourself, does it make sense with everything else that you're doing? When you move your 401ks to IRAs, typically you can invest in an array of things. It could be mutual funds, it could be stocks, it could be ETFs, it could be real estate. You got the flexibility of potentially converting to Roth. I talked about that in the last segment. And, even if you're still working, and let's say you're over 59 and a half, there's something called an in-service withdrawal. So many people don't know about this. And again, it's not for everyone, but I like to talk about what your options are on this program. And an in-service withdrawal can allow employees that are still working with their current employer to do an in-service withdrawal, meaning you're going to roll over a portion, some or all of the dollars in your current 401k to an IRA. Now, you're not putting in your resignation papers. You're not going to close that current 401k. You're going to keep that thing open. You're going to continue contributing to it just as if you would any other month. And once the dollars are rolled correctly into the IRA that were once in that 401k, if done correctly, we are seeing a tax-free, and in most cases, a penalty-free transfer over. And then this allows you, in some cases, to reposition this money in a way that could make a little bit more sense for your stage of life. If you're 1 year, 2 years, 3 years out from retirement, you may want more options to hedge against future volatility leading up to retirement. You may want more aggressive options if you're trying to play catch up that maybe the 401k doesn't offer. And so it's just, again, everything you're hearing here is flexibility, flexibility, flexibility. So with that said, there's a number of people that may say, well, Chris, what type of cost are associated in moving a 401k? And I want to be very clear, because if this is done correctly, there should be no taxable event. If you've got a traditional 401k and you roll it over, it's done tax-free. It's done penalty-free. The only time generally you may see a penalty is if you're under 59 and a half and you were to take money out of the 401k, or if you're under 59 and a half, you take money out of an IRA. There is one situation where you may not pay tax on a distribution from a 401k if you're not 59 and a half. And this is a really critical piece to today's conversation, because remember, we're talking about the do's and the don'ts, the reasons you may or may not want to roll over this 401k to an IRA. So here's the situation. You turn 55, and let's say you're going to consider working beyond that, but let's say you get terminated from the employer. They let you go. You lost your job unexpectedly, and you're going to go back into the job market and try to find a new job. Well, you may need some dollars to supplement, the income that you're going to lose for a period of time. But if you're over 55 and you've been terminated, or you're no longer with a company that you had a 401k with, you can distribute money out of that thing, and you can do that without the 10% penalty. Now, you're still going to pay tax on whatever money that you distribute from that, but you wouldn't be penalized that 10%, which could be pretty sizable. But if you were to retire, or let's say in this case you got terminated, you're no longer with the employer, over 55, and you were to roll that 401k, an advisor maybe counseled you to roll it over into an IRA, you can do that tax and penalty free. But when you need to pull money out of the IRA, because it's now an IRA, it is now subject to the early withdrawal penalty of 59.5%, 10% penalty. So there may be a case where you would roll some of it over to an IRA, but if you rolled all of it, you would lose the flexibility of taking a distribution tax-free. So that's one reason those of you over 55 may want to consider not rolling everything or rolling just a portion to a 401k, but it's not everything in many cases. Everybody's situation is different. If you're fortunate enough to be able to retire confidently, you've got a written plan that shows you can pull this off with total success before you're 59 and a half, good for you, and that may not apply to you. But I want that little known thing to be understood by our pre-retirees. 512-836-0590. I want you to call in today. It's 11:27. I am in studio with you live. You can I'll take your retirement questions, anything around Social Security, IRAs, 401ks, retirement income planning, Roths, and more. And a text question here coming in from Sam. Sam is 61 years old. What percentage of my 401k should be Roth? Sam, there's not a magic percentage. I really challenge you to consider all your assets and just ask yourself, how much is in my Roth? Whether it's a Roth 401k or the traditional. In many cases, you may be saying, Chris, it's the smallest account that I have, or I may not have any Roth. Well, if that's the case, the chances are you may need to really consider getting into the Roth game. One of the considerations, particularly for those of you that are in your later years earning, dollars leading into retirement, it's a consideration of your tax bracket. If you're over the 24% bracket, let's say you're in a 30, 32, 35, 37, putting money in a Roth 401k is always a good thing long term, but if you could be putting those money into a traditional IRA and getting a tax deduction when you're in a 30+% tax bracket, that may make sense, believe it or not. And then when you retire at 62 or 63, maybe maybe at that point is when you want to consider going ahead and converting those dollars that were once going into that traditional 401k to a Roth, when you're in maybe a 12, 22, 24% bracket. So, the thing is, it's not one size fits all. So I think the first consideration for you, Sam, is if you're still working, how much are you paying in tax every year? So does it make sense to do Roth today or do it later? The other thing would just be to look at what your future required distribution amount is potentially to be. So that means you take your balances today, you put a rate of return on that, and then you look out to what that account could be worth, or all your pre-tax accounts could be worth, aggregate them all, and then look at the age of your required minimum distribution, which is probably 73, 75 for most of you today. And then you calculate that number and you go, okay, multiply that by 3.65%, and that's a good start for your required distribution amount. And look at the size of that thing. And for many of the people we work with, and we run through our process from start to finish, they had no idea that they're going to have a $100,000 IRA or $160,000, required distribution. That required distribution will beat you up. It can put you in a position where you lose a lot of your control in retirement. So all that said, look at what your future tax liability is from the RMD, because remember, every dollar in that Roth, Sam, is not going to be subject to tax, but more importantly for you, it's not going to be subject to required distribution under today's law. This is Wealth Radio. Chris Heerlein here. Great to have you joining us on our second half of the hour here. I want to encourage all of our listeners to join us at reapwebinar.com, reapwebinar.com. This is where I host virtual summits every month. This is geared towards helping you retirees and those approaching retirement make really wise financial decisions and get some of the pitfalls out of your path as you walk into this great season of life here. So reapwebinar.com to tune into those. And I also want to put out there, because we've been talking about rolling 401ks to IRAs today, and some questions coming in around what the tax implications are, what Roth looks like in that. And I want you to get a copy of my Roth report. Actually, just shoot me an email. We'll make it easy. Go to chris@wealthradio.com. chris@wealthradio.com. My team will send our updated Roth report for 2023 right to your inbox. It's at no cost. So get your hands on that. As we're wrapping up this portion of the IRA 401k conversation, there is something I want to talk about, because the year end is upon us, and everybody's going, what kind of opportunities are in front of me? What can I do in the next 2 months to ensure that I can minimize my tax for this year? And oftentimes you can't do things after the end of the year. You can make contributions to IRAs and things of that sort prior to your tax filing date, but that's kind of a reactive way of doing things. That's after you've called your CPA, January, February, dropped your docs off, and he calls you and she calls you, and they go, you owe X in taxes, and you're going, oh my gosh, what can I do? Well, that's a reactive method, and that's not what happens at Reap Financial. Our clients are educated throughout the weeks and months leading up to the end of the year as to what you should be doing, what we can help you do to reduce that tax bill. So let's talk about some year-end things here around these IRAs and 401ks. First off, maximize your contributions. That's simple, okay? That's an easy one to think through. You may say, well, Chris, I've got a lot of headroom still. I want to max out my $30,000 in my 401k, but there's only 2 months left in the year. Well, go to your employer, go to HR or custodian, whoever is administering that plan, and see if you can withhold more from your check in the coming couple months to get towards the max. Well, Chris, where am I going to live? How do I pay my bills if more of my check? Well, think about your other investments. Do you have cash sitting at the bank? Do you have some brokerage accounts where you could potentially raise some cash? That way you are maximizing the 401k and the tax deduction that comes with that. So you can supplement. You're robbing Peter to pay Paul, if you will, just by being a little more tactical on where you're going to pull money from. So see about maxing out the 401k, and then same is true with your outside IRAs. If you are under certain income thresholds, you can contribute to your 401k and you contribute to an outside IRA, and that could be a tax deduction for you as well. And even if you have a spouse that's not working, let's say you're the only one working in the marriage, and you've got enough money to substantiate a contribution for you and your spouse, you can do what's called a spousal contribution. And that amount would be potentially tax deductible as well. So you can kind of double up there. Back to the 401k, if you're under 50, there's only a certain amount you can put in. But if you're over 50, you can do those catch-up contributions. So if you've recently crossed that threshold from 49 to 50, 51, and you haven't gone in and adjusted how much you're contributing, just keep in mind you can contribute a lot more over 50, that's going to give you more of a tax deduction. So keep that in mind. Now, one of my favorites when it comes to the year end is think about your charitable intent. Okay, how much have you given this year? A lot of times people consider giving at the end of the year to causes they believe in to, again, get some tax deduction while helping the charity of their choice. One account that is becoming more and more popular is called a donor advised fund. It's been around a long time. Donor advised fund. Think about it like your charitable savings. This is something we establish for clients at Reap Financial all the time. And what this allows you to do is you can put money in to these accounts. You can put cash, you could put stocks from a brokerage account in there, and the money can be invested, it can stay invested. It can grow. And whatever amount you put in that donor advised fund in this year, you would get a tax deduction on up to a certain amount. Okay, so by doing that, you're getting that tax deduction that you want, and you still have control of the money from the standpoint that you didn't have to give it directly to any charity yet. So all you've done is taken money from your cash or your brokerage accounts, whatever, and you've got that now put into a donor advised fund that you can manage. And then when the time is right, you can give out of that account to any charity of your choice. You can donate dollars out of that to any charity of your choice, as long as it's a qualified 501c3. Now, when you give out of it, let's say you put $20,000 in this year, and next year you give out of it. You're not going to get a tax deduction when you give to the charity out of that account. You got the tax deduction more than likely in the year that you put it in. And so let's not be confused there. Well, people say, well, why not just give directly to the charity, Chris? Why would I put money in a donor advised fund? Well, understand that the majority of Americans today do not itemize. Standard deduction is very high. In fact, for 2024, the projected standard deduction is $29,200. It's going to be $14,600 potentially for single filers. So unless you're itemizing, you're getting over those high limits. Those are very high. You don't get a tax deduction on your charitable contribution. Now, I know you don't just give because you want a tax deduction, but think about this. If you can give strategically and still get a tax deduction, doesn't that make sense? So by donating to your donor advised fund, it can allow you to put enough in that thing to get above the standard deduction, all while not having to give it all to one or multiple charities in a single year. If you had a big bonus at work and a big spike in your tax bracket, let's say you sold a highly appreciated home this year. Let's say you're working with my team and we do a big Roth conversion for you. All those type of taxable events can be mitigated by donating to a donor advised fund. So if you're already giving charitably and you've got a big bump in your income or capital gains in a given year, a donor advised fund could make a lot of sense just from the standpoint that we can reduce your tax bill and stockpile some cash for your future giving, your future family's giving. We have clients that will leave these donor advised funds to their heirs down the road, and the family can give to charities of your choice or your kid's choice in the family name. You can even put in your trust how those dollars must be directed, even after you're 6 feet under. Okay, so very flexible. There's no minimums on how much you can put in. Most of these accounts you can start with anywhere between $0 and $5,000, depending on the custodian. There is some limitations on how much you can put in. It's a limitation of $100,000. That's per spouse, by the way. So I know that's a pretty extreme number, but they do allow a pretty liberal amount to go in there, $100,000 per person. So great strategy there for your year-end tax. Consult with the CPA, fiduciary advisor as to if that makes sense. But again, educating you on maybe some options you didn't know about this morning. One other is if you're over the age of 59 and a half, or sorry, 70 and a half. My apologies, 70 and a half. There's a lot of halves in these retirement game. You can do what's called a qualified charitable distribution, a QCD, and so you can direct money out of your IRAs to charities of your choice. Why do this? Why, Chris? Why do you tell us that if we're giving charitably, the first dollars you should be giving are from your IRA? Let me tell you exactly why. There's a couple reasons, but let's get the top 3 reasons. Number 1, if you give money out of your bank cash, brokerage, and you aren't itemizing, okay, you're not going to get a tax deduction. If you are forced to take a required distribution because you're over 70 and a half, well, most people, what they do is they take that money out, they deposit it in their savings, and then they give charitably. So all of that amount that you were forced to take shows up as income, and then you're giving charitably. And again, if you don't itemize, you're not getting a tax deduction. Okay, so keep that in mind right there. But to take it a step further, if you had a $20,000 required distribution this year, and you took 10 of it to the bank savings, and then you sent 10 of it to one or multiple charities, well, that satisfies your RMD because it came out of the IRA. So in the example I just mentioned, you would show $20,000 if you didn't do a QCD. If you took 10 and then donated 10 direct from the IRA, 401k, and in that case, you'd only show $10,000. So it's better than a tax deduction because we're getting income completely off your Schedule A here. It's better than a tax deduction. You're shaving income off the bottom line. That's taxed at income tax rates. So keep that in mind. Good food for thought. Qualified charitable distributions, they can definitely bring some complexity to your year-end planning, so don't go at it alone. Also, bear in mind that in most cases, if you do a qualified charitable distribution, you need to inform your CPA of this. In most cases, the year-end tax docs are not real clean and clear, and the CPA may not know that the $20,000 in this case, 10 of it went to a charity or multiple charities. So they need to notate that in many cases on your 1040 so that it's reported correctly. And always you could go back and amend, but that can create a rat's nest as well.